all inflation in most cases, I should say, I don't know all. Right now, the inflation that's been created has all been self-induced, right? It's been by the Federal Reserve and by our government. Okay, so absolutely, that's why this market, this last move from 2020 to 2022 is like a blow off top. That's all. It's like funny money. That's why the market's crashing the way it's crashing, because that's not real returns, because it wasn't real money. It was all printed, and that's inflationary. All the inflation, what you perfectly said, Peter, has been caused by all the money that was the free money, the getting paid not to work, more money, right? It's better to stay home and get paid 50% more in income than if you got a job.
Welcome to the Retirement Architect with David Reyes. Our program is designed to not only provide insight, but to educate and give you the tools you need to design and build a rock-solid retirement.
Welcome in. We are with the Retirement Architect, David Reyes from Reyes Financial Architecture. We're going to tackle an important topic that we are facing: inflation, paying more for almost everything that we have to buy. And David, this is especially difficult for those in retirement, a real challenge in an inflationary environment. You see this coming to an end, or what do we need to do about it?
Yeah, it's funny. In a book that we co-authored about 3 years ago, Mama's Secret Recipe to Retirement Success, I wrote a whole chapter on inflation. And I did that. I chose that topic in a non-inflationary environment because that was my concern, as an advisor for 2 decades, that we hadn't hit that. And it made me study the 1970s and early 80s. And when Ronald Reagan was president, he had a great quote, which is in the book. And he says, his inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. That's a great quote. And Ronald Reagan, of course, was an actor, right? And a great president, in my opinion. But that about sums it up, right? Because it permeates everything, right? Right now, you have inflation running, as of this podcast, around 8.3%. That's definitely a low number relative to what the actual number is. There's a site called Shadow Stats, and they actually look at what 1980s, 90s inflation, how they have adjusted it based upon the new math, right? It's called government math. And really, inflation is probably running about 15%, 12 to 15% is really more accurate. And we know that gas prices, food prices, they're not up 5, 10%. They're up 20. Go to a restaurant, right? I have a family of 5. I mean, our bill is ridiculous. It's double what it was, a year ago, 2 years ago. So inflation, when we do retirement income planning for clients, that's a problem, right? Because if inflation is running 8, 10%, and we're on fixed incomes and we're trying to produce fixed incomes, that's a problem, because the fact is we don't know where this is going to end up. But the fact is that we are having to make that part of the plan to ensure. I just did a new retirement plan for a client, and we were using 3, 4, 5, 6% inflation factors in there just to address the potential problem. So it is a problem. We don't know when it's going to be tamed, right? It's going to come down at some point, but is it going to come down to 5%? 4%, 3%. Now, Chair Powell, our fine Federal Reserve chairman, is trying to shoot for 2% inflation. I think in the new world that we're in, with an alliance of really kind of China and Russia and the West and Europe, you have supply chain disruptions. You have the energy problem. I think 2% inflation, in my opinion, is a pipe dream long term.
David, do you see any strategies that can specifically help retirees to combat the potential impact of inflation?
Yeah, the generic answer, if you ask a stockbroker, they'll say stocks appreciate over time more than inflation, which is true. Stocks have averaged the last 100 years about 10%.
But David, if we go back to those Reagan years where we were seeing inflation and the Fed took a similar approach, raising interest rates, similar to the current scenario, the market also similarly did not fare so well during that period.
Not at all. Exactly. So my point is that's a lazy answer, right? Yeah, fine. Over time, over the next 50 years, you'll outpace inflation, but clients are looking at 20, 30 years of retirement income, right? Average life expectancy is 80. And it's just what it is. And the average retiree retires at 65. That's 15 years, right? A lot can happen. That's a blink of an eye. So we can't be that apathetic about what we do for that. So when we do planning for clients, we're going to say, how do we create the most, principal protected income that we can get? The nice part about it is there's products I've used for many years that we can get lifetime income streams that actually can have inflation protection. On this show, I don't want to get into too much of the weeds with that, but basically think of it like cost of living. So let's just say, cost of living is 3 or 4%, 5%. We have mechanisms within the policies that actually will allow for increases in income. That's a safer way to not only am I getting my guaranteed income, but I'm also going to get the potential for increase in my cash flow. Unlike the stock market, right, which you're talking about, where there's no guarantee, right? I can lose all my money. That doesn't mean we don't put money in the markets, but if we're going to create a conservative plan, and I have a conservative client, which my clients are, we want to look at how do we principal protect, how do we get some guaranteed principal income, and how do we increase income if we have inflation. And we do. And those are kind of strategies we're using today, kind of dusting off the shelf that we haven't used as much the last few years that are a big part of our planning now.
David, according to the charts from the Federal Reserve's economic data, the Fed, 20% of all dollars, all the money currently in circulation, has been created since the onset of COVID. Do you think that pumping that much money into the economy is one of the contributing factors of the inflation that we're seeing?
All inflation, in most cases, I should say, I don't know, all. Right now, the inflation that's been created has all been self-induced, right? It's been by the Federal Reserve and by our government. Okay, so absolutely. That's why this market, this last move from 2020, 2022 is like a blow off top. That's all, it's like funny money. That's why the market's crashing the way it's crashing, because that's not real returns, because it wasn't real money. It was all printed. And that's inflationary. All the inflation, what you perfectly said, Peter, has been caused by all the money that with the free money, the getting paid not to work, more money, right? It's better to stay home and get paid 50% more in income than if you got a job. You know, those kind of things that were making me cringe during the crisis, which I get it. You can't disincentivize people to work and pay them more money. What happens is they go spend the money. And now you're in this spiraling inflation that's permeated every part of our economy. And once that happens, and that's what Federal Reserve Chairman Powell now finally realizes, is that we have an inflation problem, and that is not going to go away unless once you get to 5% inflation, you have to get the federal funds rate above the inflation rate, which right now is 8%. We're only at 3% Fed funds rate. That's why Powell's being so aggressive. He's hoping that will kind of come down, maybe get down to 4 or 5%, to where now you have Fed funds above, if we get to 4 or 5% Fed funds rate. And so he's on the right track. Finally, he misplayed this really badly in last year. And he's trying to make up for lost time. But that's part of the problem when you have such a reliant on the Federal Reserve for stock markets like we've had in the real estate market for the last 15 years.
David, once we've seen costs and prices increase the way that we have, once we've seen inflation set in, does it really ever go back down?
Yeah, I mean, to give you an example, when you went through in 2007, I think inflation was running around 5%. Don't quote me on that. It's around there. But that was more normal inflation. That was just because you had a very hot economy, hot housing market, hot stock market. You didn't have all of the Fed-induced stimulus in the economy yet. Just like you said, 20% of our total debts have been created in the last 24 months. It's insane. And so, but what happened was we actually had CPI go negative within a year and a half. Now that's a different world now. We're in a different world. We have the supply chain issue. We got the war in Ukraine. We've got China, which is really in bad shape right now. And so all these things are really adding to answer your question directly, is that it's adding to really elongating the inflation problem, in my humble opinion. I think it's more of a structural issue now. We're going to have to onshore a lot of our supply chains, which we should have done a long time ago. Look at the Semiconductor Act we just had. We're trying to onshore semiconductors. Taiwan's a problem. The Chinese may want to invade Taiwan. There's all these issues that are really going to make, I think, inflation more sticky than we'd like. And so, what I'm projecting out for the next couple of years, I'm looking at 4 or 5% inflation. We haven't had 4 or 5% inflation like that persistently since the 70s and 80s. You know what I mean? So most clients are not prepared for that. And so we want to make sure that we have that inside of our planning.
He is the retirement architect, David Reyes. If you would like to engineer your retirement blueprint, the proprietary plan that they put together for you there at Reyes Financial Architecture, how to attack and address the potential for continued inflation throughout your retirement years, pick up the phone and give a call, 858-597-1966. That's 858 1966. You can also visit online, reyesplan.com. That's REYES plan.com, reyesplan.com, or again, 858-597-1966. David, inflation is going to be a continuing concern. We all need to have that retirement blueprint, and it's specifically in retirement, how to plan to address inflation.
Yes, sir. Yeah, no question. That's where I think, again, the missing link for most clients' plans is that inflation is not part of that plan. And how do you plan for 5, 6, 7, 8% inflation? There's things to do. Nothing's perfect, but at least we're going to be proactive about dealing with that issue and that challenge.
But if your plan does not address the current inflation, or even just the regular inflation that we are certain to see over the coming decades into and throughout retirement, probably a pretty strong indicator that you need to engineer a retirement blueprint. You can give a call to Reyes Financial Architecture and the retirement architect, David Reyes, at Reyes Financial Architecture, 858-597-1966. That's 858-597-1966, or online, reyesplan.com. That's REYES plan.com, reyesplan.com.
Thank you for spending your time with us again this week. Get the most out of your retirement plan. Call 866-REYES-PLAN. That's 866-REYES-PLAN, 866-739-3775, or visit reyesplan.com.
No information presented today should be acted upon without meeting with a qualified and licensed professional. Reyes Financial Architecture, Inc., RFA, is an SEC-registered investment advisory firm. Such registration does not imply a certain level of skill or training. For a copy of RFA's current form ADV-2A brochure that includes a description of services provided, fees charged, and other important information, call 858-597-1966 or go to advisorinfo.sec.gov. RFA also is a licensed insurance agency with the state of California. License number 0G66604. This show is provided for informational purposes only. Opinions expressed in the show reflect RFA views as of the date of the recording and are subject to change. Nothing should be construed as a comprehensive statement of the matters discussed, considered investment, financial, legal, or tax advice, or a recommendation to buy or sell any type of security, and no investment decision should be made based solely on any information provided. Any forward-looking statements or forecasts discussed are based on assumptions, and actual results can vary from any such statements. Some of the information provided has been obtained by third parties and believed to be reliable, but not guaranteed. Past performance is not an indication of future returns. With respect to any discussion about RFA investment strategies, there's no guarantee that they will be profitable or perform as described during the show. RFA or one or more of its employees may have a position in the securities discussed and may purchase or sell such securities from time to time. All investments in securities carry risk, including the risk of losing principal amount invested. Different types of investments involve varying degrees of risk. There can be no assurance that any specific investment or investment product will be profitable or suitable for a particular investor's financial situation or risk tolerance. Asset allocation and portfolio diversification cannot ensure or guarantee better performance and cannot eliminate the risk of investment losses. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing insurance company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Surrender charges apply to base contracts. Optional life income benefit riders are used to calculate lifetime income payments only and are not available for cash surrender or in a death benefit. Fees may apply. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Rates and returns mentioned on this program are subject to change without notice.